Welcome to BizTax, Canadian business expansion to the US. It is the first part of our new series that my partner Namir Hallak will be talking about a little bit more later. My name is Atif. Happy Stampede to everyone who are in Calgary. And we almost decided to wear our cowboy hats, but then we let it skip. So we are very excited to talk about this topic. Today, there's going to be 12 episodes. And today, some housekeeping matters before we start. There's going to be audience participation in this webinar. There's going to be polling questions, 3 of them. And there will be questions by you that we will answer. And then there will be a survey, and the live transcript will also be available. So without any further ado, I will ask Namir to introduce this webinar series that we are launching.
Thanks, Atif. Good morning, everyone. My name is Namir Hallak. So I'm a partner with Andersen. I'm based in Vancouver. I don't have my cowboy hat on, but I am stampeding this week in Calgary. So a little bit about BizTax. So why BizTax? One thing real quick, so that Atif, you mentioned that there's some questions in the survey. So we are excited. This is going to be the first webinar, because as you know, Andersen has been doing these webinars with in-depth discussions and case studies and some practical insights for various U.S., Canadian, and cross-border tax topics. And we've now been approved. We are eligible for continuing professional education credits, CPEs, by the U.S.'s National Association of State Boards of Accountancy, NASBA. So tune into our webinars. This will be one of them where you can earn your CPE credits. All right, so let's get started about this. So why BizTax? So experience that Atif and I both bring is a specialization, a niche, if you will, in helping U.S. or Canadian entities with cross-border activities, operations, investments, and employees. We've seen our share of some really, really interesting cases, questions, and solutions that we'd love to bring to our discussion here together. And a lot of the companies that come to us, they arrive at really different various stages of this company's life cycle in expanding their business across the border. So I think it's really important to emphasize here that if you are a U.S. or a Canadian business with these cross-border operations, you want to work with a cross-border team that is going to be well-versed in U.S. and Canadian tax to help you holistically see the full picture. So now, here's your U.S. tax issues siloed out, and here's your Canadian tax issues siloed out. So BizTax is our webinar series. It's about cross-border tax with a focus on U.S. and Canadian entities. Now, it is going to be a 2-part series, as Atif said, so for a total of 12 webinars. And what we want to do here is we want to explore the life cycle that a lot of private shareholder-owned, so owner-managers, clients go through with their cross-border business. And so what we want to explore in these 12 webinars is what happens from the very early stages of exploring how do you expand your business across the border. And this is really the focus of today's webinar. And some of the questions we often hear clients come to us with, in terms of those very first stages, hey, can I send my employees down to the US for this business that I'm building? Can I hire US employees? How do I finance this cross-border business? And then, the big question that comes up often is, well, how do I structure this? What is the right structure for my cross-border business? And then what are the strategies to get my business profits out of this US business? If I want to get this back into my, pocket as a Canadian shareholder, a Canadian owner. And what are some of the strategies that I can do to get those profits out? And then what is your overall, exit plan? Sometimes owners come to us and they already have in mind, what they want to do with the business, how they want to grow it, how they want to exit out of it. And so, we love to see our clients thrive, and we want to see you positioned to grow. And you need to be focused on setting up your business up for success. And we want to help you navigate this road without getting bogged down with or even overwhelmed by some of the tax complexities that can show up when you cross the border. So we're going to break up this BizTax webinars into 2-part series for a total of 12. The first parts, the first 6 webinars, will be with an outbound focus. This is for Canadian businesses that are expanding down to the United States. Now, the second part is going to be 6 webinars with an inbound focus. So this is for US businesses that are now expanding up to Canada. And Atif, you want to go overall through the agenda for today's session?
Right. Thanks, Namir. As Namir said, it's a very things can get pretty overwhelming and complex. So we have tried to break down our agenda into several parts as a starting point. And as we move forward, things will get a little bit more complex and interesting as well. So first, Namir will talk about unlocking tax treaty benefits. Tax treaty is a friend of yours when you are going across the border. And then you have to make a decision whether you're going to have a branch or you're going to have another entity, a subsidiary in the US. We will briefly touch upon that. Then we will get into the financing, how you should finance your business. Is it going to be equity or is it going to be debt? And what are the things to watch out for, the surprises, and you want to be prepared for them. Then we will talk about employees working in US. So now your business has expanded and employees are going across the border. It's not as simple as that the employees go and come back. You have to watch out for a few things to make sure you don't get caught in complex tax rules. And then Namir will talk about navigating US state taxes. So so we go into unlocking tax treaty benefit. And Namir, I have a question for you before you go there. But so our situation is that we are starting out. Canadian individuals own a CanCo, which is a Canadian controlled private corporation. And now they are thinking of expanding into the US. And what questions, Namir, come to the table when you meet Canadian business owners who are planning to go across the border to the US?
That's a great start, Atif. It's interesting because, a lot of times when Canadian owners or Canadian individual shareholders, they've got this business set up, they're doing great in Canada. And, when they come to us saying, hey, I'm really looking to go into the US market, there's a lot of reasons why that's happening, a lot of drivers there. And, the way this conversation starts, there's so many different iterations of what this can look like. But a lot of it really comes down to Canadians often look at the US market and they're driven, by the size of the market and the depth of demand for their products that they can get from accessing the US market. And some of it too is that they look at the US and they say, maybe I need to have a US structure because I need to, raise my US profile. And that can mean, for example, maybe your client says, I'd like to see a made in USA on your product. That can be one reason for it. The other thing too you see is, especially in today's e-commerce world, is a lot of companies are, they're developing their internet presence, they're building their website, they're building, their branding on, let's just say website for now, their internet presence. And that alone is going to drive a lot of US activity. It's going to attract a lot of US business. It's going to bring in the US customers. The other one I also see, and this is a really interesting one too, is, and we'll talk more about this, we'll explore this later, is sometimes a Canadian business is looking at the US market. Maybe they've already started to already sell to a US customer. But what happens is, they start realizing, I'm sitting in Canada, I'm sitting in Calgary, I'm sitting in Vancouver. I think I need somebody on the ground, and so they start hiring these sales reps across the US who can help them scale their business and build their business, and that's great. But then comes the question, okay, well, I'm really excited you're growing your business. What does your tax picture look like now? And how can we help you manage that better? Now, one of the first stops in those intake calls, in trying to understand their business is going to be around that. What is going to be the source of your revenue? And, each country's domestic rules will generally define how you source that revenue. So to give you an example, so if clients are selling like an actual tangible product, one of the first questions I want to know as I'm, gaining an understanding of their business and understanding the drivers of the owners, understanding more about where the shareholders are at and their residencies and all that, I want to know, okay, so tell me about your business. And so I want to know if you're selling, for example, a tangible product, because we want to understand first the income sourcing. Where is the title for that good transferring? So where are the rights and interests of that tangible product transferring? So if it transfers in the US, I'll say, okay, well, so we now know that there's going to be some US sourced revenue. Your product is, being sold in the US. Or if you have services, now services are an interesting one, right? Because this one's pretty intuitive. The services are sourced where the services are performed. But with the internet now, a lot of that means is, you could be performing those services almost entirely as a Canadian business in Canada. And US federal tax law really hasn't changed that significantly on this yet. So generally that means, if you are performing those services in Canada, it'll still be sourced back in Canada.
So Namir, let me just jump in there here for a second. You mentioned income sourcing. So the example that you're talking about, the situation, Canadian business has started to operate in the US and the income is sourced in the US.
Yeah.
Is that the point where Canadian corporations should start thinking about filing a US tax return?
It's a really good question. So, that first stop on that road to your cross-border business expanding is identifying, okay, so we now know that we have US source revenue. We have income that we say can be sourced to the US. But at what point does that take us to a place where we say, okay, now we have US taxes owing? And even before that, at what point do we say, do we have even a US filing with the IRS or potentially with states? So I see it as like a 3 stops on the road. The first one is your income sourcing. And the second stop on the road is, do you actually have a US trader business? So now that you have US source income, the next stop is, do I have a US trader business? So what this is about is, once the Canadian business activities in the US are to the level of what we call a US trader business, then you actually have a US federal tax filing requirement. And, a lot of Canadian businesses, when they come to us for this, they're a little bit surprised when they're doing business out of the border that we say, hey, you've got US source revenue. They knew that it was going to happen. They knew that, they see they have US customers. But they're often surprised when you say, well, you have a US trader business here. And it's funny because when they think of a US trader business, they often think of a, brick and mortar store, even though they probably don't actually have a brick and mortar store in the US yet. And the interesting thing about that is, the tax code in the US, the Internal Revenue Code, they actually don't have a definition of what is a US trader business. Now they have a provision that says personal services, if you're performing any sort of personal services, think like, let's say painting a house, anytime during the US, that'll be a US trader business. And there's some exceptions to that, by the way, as well. But really, the determination of whether your Canadian business that has now this US source revenue has a US trader business or not is really a facts and circumstances test, because a lot of this has been left to the courts. So when you want to figure out whether you actually have a US federal filing requirement yet, whether you have to file something with the IRS, you'll want to know whether you have this US trader business. So you'll want to look at whether US business, you'll want to know whether the Canadian business is engaged in a substantial, regular, or continuously ordinary business activity in the US. So what does that mean? Well, if you're doing a one-off or some occasional transaction in the US, generally do not create a US trader business. But if you are making sales throughout the year, it would be really tough to argue that you don't have a US trader business. And it's important to say that this really is about that second stop. So saying you have a US trader business, you have a US federal tax filing requirement, this doesn't necessarily mean that the IRS has jurisdiction to tax you yet. And the reason I say that is, Canada and approximately 60 other countries actually have a tax treaty with the United States. And what the Canada-US treaty does is it overrides areas of the US-Canada domestic tax law. So amongst things that it does is it reduces your instances of double taxation. So absent the treaty, knowing that now you have a US trader business, that US business activity would be otherwise subject to US federal income taxes. So businesses that are in countries that have a treaty with the US, like Canada, means that the treaty is going to limit the ability of the US, the IRS, to tax only those business profits that have a close relationship with this construct we call a US permanent establishment. And, the thing about permanent establishments is, again, this is another one of those things where it's a bit of a misnomer. So a lot of clients, when they're new and they're expanding to the US, when they think of a permanent establishment, they think, okay, well, that means, again, I have to have a brick and mortar in the US. Does that make sense so far, Atif? Does that follow kind of along?
Yes, it does make sense. Let me just recapture what you're saying, and then I have a question for you. So you started out with sales in US, and then you talked about bricks and mortar, and now you're saying that bricks and mortars is not the be all end all. There are other things to look for.
Yeah.
And now, for those businesses that are not too far into complex situations, and they shouldn't worry about permanent establishment, can you give us some examples where you have come across a situation where a client thought that, oh, I have a permanent establishment, maybe I need to file a US tax return, but they didn't need to?
Yeah, that's a great question, Atif, as well. I think our discussion of permanent establishment thresholds matter, and that's why we have to look at the U.S.-Canada Treaty and interpreting the U.S.-Canada Treaty. Because you can have that scenario. You can have that scenario where a Canadian entity may still be doing business in the U.S. You've got a U.S. trader business. We've established that based on the activities they have, but they may actually still be falling below the threshold of having a U.S. permanent establishment. So they will not be subject to U.S. federal taxes. They may have a U.S. federal filing requirement. They have to file something with the IRS, but they may not be subject to U.S. federal taxes. So in our client base, we see this often with Canadian businesses as they're expanding to the U.S. And it ends up being often like a slow march to a position where they have a U.S. PE and then they're subject to U.S. federal taxes. But they may not initially be at that threshold. So I'll give you a few examples to your question here. There's a few scenarios where we see clients doing business in the U.S., but they're still below the activities of having a PE. So one of them is if you are selling to the U.S., you have your product going to the U.S., and maybe even your employees are infrequently traveling to the U.S. But for example, you don't have a fixed place of business in the U.S. where the business is being carried on. So that could be an office or factory, or maybe even like a long-term construction project. Now that's a bit of a common scenario, but another common scenario is, Canadian companies can even have, they can maintain a stock of their Canadian product in the US, and they can have it there for storage or display or delivery for their customers or for those sales reps that we talked about earlier and they hire in the US, and that won't trigger the USPE. Now, the other one that I think is really interesting too, and this is one that comes up often, is a lot of Canadian businesses, when they're expanding, again, they'll hire those sales reps in the US. And that's important because you want those sales reps to, they're going to know and understand the local sales market. Maybe they'll have relationships with local partners and vendors. And that fact pattern alone does not trigger a US permanent establishment. What you'll want to ensure there is you'll want to make sure that those sales agents, now I'm assuming these are dependent sales agents and not independent contractors. That's a different discussion. But for those dependent agents that are working for your Canadian company, you'll want to make sure that they are substantially concluding and authorizing and approving those contracts in Canada. And I want to say, this is important. You have to really, again, look at all the different critical elements that go into that process. So it's not a matter of bringing documents back to Canada to get them rubber stamped. You'll want to look at all those critical elements. Even looking at the creditworthiness of a client, those elements need to be done in Canada, and you need to make sure they're being finalized in Canada. And the other one I want to talk about too is services. So you can still have a Canadian business performing substantial services in the US. And this won't immediately translate to having a US permanent establishment. So that doesn't mean you will immediately have US federal income taxes, even if you're performing substantial services in the US. But what you'll want to look at, again, is look at your customer contracts. How much time are your employees actually spending in the US in any 12-month period? And you also want to look at if you have several employees scattered across the US, if they're working on connected projects, whether they're connected commercially or geographically, you'll want to track all their time to make sure that, because there is a services PE, there is a way where if you are in the US for over 6 months, for over 183 days in a 12-month period, and there's different provisions there, you could still trigger that. But you want to track all that time to make sure that you can still fall below the threshold of a permanent establishment. Now, just to clarify one thing too is, we often, when clients are in that slow march towards a PE, you'll want to stick to doing your business in the US using a Canadian corporation. So if it is established that you don't have a US permanent establishment, you probably don't need to go out there and structure a separate US entity yet. And often what we do here for clients is we'll provide them with do's and don'ts to ensure that the business and its employees are not triggering and exceeding that PE threshold. And the reason we say that is, you'll want to make sure if you are filing a treaty-based return, and I say that because if you have no PE, the Canadian company will have to file a treaty protective tax return, but it's not going to be subject to US taxes. And all that really is it's a declaration to the IRS that the Canadian company is engaged in activity in the US, but it discloses a treaty position that it is protected from US federal income taxes. And that comes with a $10,000 penalty if it's not filed on time for disclosing treaty position. And if you don't file that return, you can also potentially lose your ability to claim expenses or deductions against that US income. So you'll want to still file that federal return, even if you don't have a US PE. And one more thing, just to clarify that before we move forward on this, is again, even if you don't have US federal taxes and you're filing this US federal return, I do want to clarify that you may still have state tax obligations and filings. And we'll go through that here shortly as well. I guess one more thing here, just to clarify too, before we move forward on the US-Canada treaty. Now, you'll want to make sure that as a Canadian business that you are eligible and you're entitled to the US-Canada treaty benefits. So as a corporation, you need to meet the test, and what you see here is the limitation of benefits provisions. And so there's a couple of ways to get there. One of them is if you are a pubco. So if your company's principal class of shares is primarily and regularly traded in one or more recognized stock exchanges, you would be eligible. The other one that we see often with privately held businesses is the ownership test or the base erosion tests. And the ownership test essentially says that if more than 50% of the vote and value of its shares are owned directly or indirectly by Canadian or US residents, then you've met the ownership test. And the other one is this base erosion test. And what this is that you'll want to make sure that as a Canadian business, that the expenses that you're paying or that are payable by that business are not going to non-qualifying persons, or if the amounts that are going to non-qualifying persons are less than 50% of the Canadian company's gross income. So all that really means, a non-qualifying person, again, this means a non-Canadian or US resident. All that really means is that for the base erosion test, you'll want to make sure that the Canadian company's expenses are mostly going to US and Canadian suppliers or vendors, for example.
Namir, I have a question about the ownership test here.
Yes.
Coming back to the case that we have Canadian individuals that own Canadian corporation, and let's say, for the sake of argument, that they have a business in the US. So those Canadian individuals, if they are resident of Canada for the Canadian tax purposes, then the CanCo qualifies for the treaty benefits?
Correct.
Okay.
Correct. And okay, that covers us on the treaty. So if I want to go to the next slide. All right. So the other thing that comes to us often with clients as they're expanding their business to the US is they often come to us with the idea that they want to have a US entity, or they want to do business in the US with a US entity. And I want to clarify here that even if you are in that position where you have a US permanent establishment, there is no requirement to actually use a US entity. So I think it's critical that if you're going to get a structure that actually makes sense. Even if a separate structure is even needed. So when we're looking at the current operations of a business, and we're trying to ask, okay, well, do you want to have a separate legal entity, or can you operate directly in the US? And there's a lot of reasons why a Canadian business is exploring having a US entity. It could be, again, having that made in USA branding, maybe that's important. It could be around having the legal liability for owners. But I want to have questions answered around, well, how profitable or valuable do you expect this US entity to be compared to your US businesses? Are you looking to, for example, defer your taxes? Or do you want to, for example, do you want to retain profits in the US business, or do you want to distribute those profits back to you as Canadians? And the key thing here to remember is, a structure from a Canadian perspective is going to be different than the answer you're going to get when you talk to a US CPA around what is the best structure to hold that US business. And the reason for that too is, Canadians generally pay higher tax rate, and they're not going to want to flow through structure, for example, a limited partnership that's going to pick up all that business income. And we're going to have a separate presentation in our webinar that goes specifically into structuring your cross-border business. But those are the questions that we look at when evaluating, do we want to have a direct or a separate structure? We want to evaluate, what are the nature of those payments that you're going to potentially distribute back? And what's the timeline for that? Because you really want to make sure that if you are going to be paying US federal income taxes, you can also pick up a foreign tax credit or deduction against your Canadian income taxes for that.
So the essential point here is that you mentioned the word holistic in the beginning, Namir. So this is a perfect example of that you can, this is a simple situation, but if things get a little bit more complicated down the road, the structure gets a little bit more complicated, then the US and Canadian tax specialist collaboration is key because you might get a perfect Canadian tax plan or perfect US tax plan, but if they are not well coordinated, it can create more tax expense than you anticipated. So now Namir has touched upon these things here that I'm going to cover now. What are the pros and cons of the branch? So you're not setting up a corporation in the US. Your business has expanded into the US, and then you're running it as a branch, meaning that you have a permanent establishment now in the US of your business, but the Canadian company is running the business, not the US subsidiary. There is no US subsidiary in the picture. One of the benefits is lower cost, relatively speaking. You don't have to set up a legal entity. You don't have to involve a lawyer to incorporate a company. You just operate as a branch. And the other benefit of a branch is that, or maybe a con, is a liability. If something goes wrong in your business in the US, then Canco is liable for any lawsuit that happens to your US operation if you have a branch. So you have to be cognizant of that. If you have a corporation, then that US corporation will be responsible for the lawsuit, and your liability will be limited to your US entity. Now, if you have an asset that is really valuable and it is sitting in Canco, maybe consider setting up a corporation in the US, everything else being equal. The other advantage of having a branch, initially when you start a business, it incurs losses. So a branch is incurring losses, and Canco has profit in the Canadian operations. So you can use the losses of the branch against your Canadian income on your Canadian tax return. Not something you can do when you have a US co, because US co will be a separate entity. It will accumulate the losses, and maybe you can use it against its own income down the road, subject to the US tax rules. The other benefit of branches is a speedy setup, and there's a foreign tax credit that you can claim. So if your branch, and this is a critical point as well, if you have a branch, you have to set up a separate business in your books. So you will need financial statements that tracks the revenues and expenses of the US branch. You calculate the income or loss of the US branch, and then you file a US tax return using the revenues and expenses of the branch. Remember, Namir talked about that if you have a permanent establishment, you're liable to tax in the US. So you are paying tax in the US if you have a branch. But those taxes that you have paid in the US can be used as a foreign tax credit in Canada when you bring the income back into Canada. So if you have paid 25% tax in the US, and I'm picking up a number out of just from thin air, and then you have a 30% tax in Canada, you get a credit of 25%. So you end up paying 5% additional tax in Canada for your US income. Now, on the separate legal entity, the pros and cons are similar, just going in the opposite way. There's higher cost because you have to set up an entity. You have to incorporate it. And there is no liability exposure to Canco. And there is the disadvantages, you can't utilize losses, as I talked about earlier. And Canco is not caught by the US rules because US entity is operating independently now, and it's liable to US tax, not the Canadian entity. However, if you want to have some financial credibility, everything else being equal, and the US co needs to borrow money from the US bank, then it might be helpful if the money is asked by the US company as opposed to the Canadian company. There's more financial credibility because US co is operating in the same jurisdiction as the bank which is lending it the money.
I guess one thing to add there to Atif is, again, when you're looking at structuring this, the reason today's webinar is really a focus on that very first step, right? So it's a focus on, you're not maybe at that position yet where you do want to structure this with a complex cross-border structure. And we're going to go into that, like I said, in a separate webinar. But one thing that's a distinction here too with the branch is, if you have this US business and it is growing, I think one of the challenges you'll have also with the Canadian branch is, the US business profits that you have for that US business, if you are set up to operate directly in the US, is the Canadian company is not going to actually be eligible for that, potentially for that small business deduction or even manufacturing processing tax credit from the US branch profit. So, potentially the income that you're getting from the US business could be getting taxed at that highest marginal rate, assuming you're going to be ineligible for that as a US branch.
Correct. Thanks, Namir. No, that's key. As you said, we'll cover it in more detail later. But if you have a CCPC that qualifies for small business deduction, and if you set up a US co underneath it, that could have implication for your small business deduction. So there are ways around it. You can set it up as a sister company, but then again, depending on the nature of the business, it can get a little bit more challenging to keep relying on your small business deduction.
And often, like we tell clients too, when they're looking at what is going to be the right structure, setting up to work and operate directly in the US as a branch could be a great answer, or fine answer, I should say, for now. But as you scale that business, as you grow that business, you're going to want to look at other options than just operating directly in the US as a branch.
Correct. Okay, we have the first polling question. So you can choose the answer on your screen. So one of the pros of having a Canco branch is A, limited liability of Canco. B, utilization of US losses by Canco. Canco not caught by US tax rules. None of the above. Utilization of US losses by Canco, 85%. That is the correct answer. As we were talking, or let me just repeat what some of the things there, that if you're operating as a corporation, your liability as a Canco is limited because USCO is not responsible for the liability issues in the US. Canco will not be caught by the US tax rules when you have a USCO. USCO will be caught by the US tax rules. However, if there is a USCO, then USCO losses will be utilized by USCO against its own income. You cannot take the US losses and transfer it to Canco. And that's where branch comes handy, because you can utilize the US losses against Canco's income, because branch is a separate business, but technically it's still a part of Canadian company. It is operating as part of the Canadian company. But good job, 85%, not bad. Financing the expansion into the US, a very, very critical question when you're expanding into the US. There are different ways to do it. You can have a debt or you can use equity. Again, we will have a separate, more detailed discussion of these options later, but briefly, when you have equity, when you make a capital contribution into the US, when you get the money back from the USCO, if you decide to repatriate funds back, you can bring them back as a dividend. And there is a whole subject there under foreign affiliate rules that might come into play. If you use the debt option, then you have an interest deduction in the US and interest income in Canada. And if you have losses sitting in Canada, that interest income can be handy. And so these are just a couple of considerations to think about.
So the thin cap rules is interesting because there actually has been an evolution on this and the change on the thin cap rules in the US and the deduction limitation rules in the US. And so assuming you are above that small tax business payer, so you're above that $29 million threshold, then you are going to be subject to whether or not those interest expenses could be limited, and that's going to be looking at but there's a mechanical calculation of looking at your overall adjusted taxable income. But with the thin capitalization rules in the US, you want to make sure that if you are not a small tax business payer, small business payer, then you will be subject to those rules.
All right. Okay. And let's say if those rules apply, Namir, let me talk from the Canadian perspective here. So the interest is not deductible if your loan is relatively more than it is expected to be in proportion to the equity. So part of the interest is denied deduction, and until you meet the certain ratio between loans and equity. Is it the same in the US, or is it all or nothing if the thin cap rules apply?
So that ratio that has been revised with the tax reform in 2017. And so what we're looking at now is if you're small tax business payer, then you are going to be subject to those rules more around whether it's going to be deducted or not. It's not looking at your debt to equity ratio. It's looking instead at your adjusted taxable income.
Similar concept to Canada, but different way to get there.
Correct.
Thank you for the input there. And the other one thing that you want to take a look at is non-interest bearing loans rules in Canada and the transfer pricing rules. So I'll cover them in a little bit more detail here. So this slide combines the thin cap and the non-interest bearing loan that is issued to US Co. And there is going to be a polling question after this, so you might want to pay attention. Now, assume a situation, and there are going to be some exceptions that you can get into to get out of these rules, but I'm going to put those exceptions aside just to illustrate the concept. I don't want to make it more complicated than it is. So let's say if Canco lends money to US Co. And what are the two big things that you should be looking out for? One of the thing is, and we often see this with our clients many times, that Canco has lent money to US Co. and they have not booked any interest income in Canco. It's a non-interest bearing loan, or the interest rate charged on the loan is less than the prescribed CRA rate. So for example, if CRA prescribed rate is 5% and Canco lends funds to US Co. at 3%, then there's going to be 2% interest income inclusion in Canco, because otherwise you are transferring capital or a loan to US Co. and not including any interest income inclusion in Canco, which is the piece that the CRA wants, and that makes sense. So there is interest income inclusion. Now on the US Co side, Namir, I'll take you that from the thin cap perspective on the US rules, because that's the one that is relevant here, the US tax rules.
That's right. So if you're not going to be subject to this as a small business payer, small business taxpayer, then the interest deduction limitations will not apply to you. But assuming that you are, then you'll have to look at your adjusted taxable income, and again, if you're limited by this, then the interest expense is suspended, but you are allowed to use it at a subsequent time. So for example, if you were a taxpayer in a loss position, that would mean that you would not be able, for example, to use the interest expense at that time to reduce your taxable income.
Okay. And here's the polling question number 2. Non-interest bearing loan from Canco to US Co is subject to thin cap rules of Canadian income tax law, interest imputation rules of Canadian income tax law, both A and B, none of the above. Let's imagine there's a Jeopardy music playing in the background. Okay, so let's go through this one by one, because there's a little bit of a split here, 63 and 33% on the two biggest answers. So thin cap rules of Canadian income tax law would not apply. Thin cap rules of the US tax law will apply here. Interest imputation rules of Canadian tax law would definitely apply. And since thin cap rules of the US tax law would apply here, both A and B cannot be correct. So the answer is B, interest imputation rules of Canadian tax law. The tricky part was that if I had said thin cap rules of US income tax law, then most of you would be right.
And I guess, yeah, also looking at whether, the US taxpayer is going to be a small business taxpayer, then they potentially will be subject to the interest expense limitation rules as well.
Right. Cross-border employees, that was briefly touched upon by Namir in the beginning. So if your business is up and running now and you are operating in the US and you don't have maybe a branch there or permanent establishment in the US there, and you are thinking that we don't need to do any US tax filing, maybe a treaty-based filing, and then, which might be right, but just be aware of this service PE rule that comes into play when we deal with employees jumping from Canadian to the US border to get the work done. They can trigger a permanent establishment of CANCO in USCO if they spend more than 183 days in the US. Something to watch out for. So if your employees are just going back and forth throughout the year between Canada and US, they are not concluding contracts, there is no brick and mortar, there is no branch, but just because those employees were there for more than 183 days, you might be caught by the permanent establishment rules. So watch out for those when you are dealing with cross-border employee situation. There are ways around it. You can set up a secondment between Canada and US for the employees, do the proper documentation, meet certain conditions, and maybe you can argue that those cross-border employees are not triggering permanent establishment because they have been properly seconded to the US. There might be payroll withholdings that could come into play. So you should be cognizant of the US tax rules around payroll withholdings. So just to watch out for those. This is one of the scenarios that we see very, very common thing. And the other thing is that if your employees are going into the US and they're spending there a lot more time than, let's say they're spending more than 183 days, they could be liable to US personal tax as well. So that is something, if you plan for, you can have those taxes cost factored into the compensation of the employees. But what you don't want is to be surprised by the US tax rules and realize that, oops, your employees are now liable for US taxes there just because you were sending them there. And that can create a little bit of awkward situation for you. So things to be cognizant of. Namir, anything you want to add from the US side?
Well, I guess a question I have for you, and we can open this up in terms of the discussion on it. But a lot of times when because the Canadian business owners they're going to be so focused on wanting to build and grow their business, which is great. But when they're sending their employees down to the US, now mind you, we're not talking about the visa and the immigration issues that come up. That's a separate discussion altogether. But I guess, do you have any thoughts in terms of any sort of precautions that you think a Canadian business should take if they're potentially having their employees have more business travel to the US, or even if, let's say, they go down this path where they do set up a US structure and maybe they're going to say, I'm going to send my Canadian employees down to the US and second there. Is there any sort of high level, especially when you're in this very early stages, any sort of recommendations for them to help manage their compliance and US federal tax issues that can come up?
Two that I can think of quickly is one, the clients should be aware of it ahead of time so that you can plan for it. One thing you can do is, if it's going to be a minor breach of the rules that triggers permanent establishment, you can contain the movement. Sometimes employees are going there, maybe they don't need to be there for 185 days, they need to be there for 160 days. And so they can work around that a little bit. They can work remotely maybe for certain days. And as you mentioned, and I touched upon it, the secondment, they can do a proper secondment setup, and that can avoid situations where you trigger unexpected permanent establishment results.
Yeah, and I would also say, and I know again, it's almost like a dimmer light where you start slowly until it's fully on and you're fully in business in the US. But I would also say, I would recommend for Canadian businesses, as you're going down this exciting path, get the processes set up. So even at the minimum, have a way to track your employees' time in the US. If they're working on more than one customer or more than one project, track that, have detail in their time. So not only how much time are they spending in the US working on clients, but what clients are they working on? I think that's going to be key, not just for your not just for your overall cross-border tax question, but also for their personal tax situation. I think it'll be very helpful to be planning that and be strategic about it early on.
That's a very good point, Namir. So one of the things we do when we prepare the Canadian tax returns for our clients who are operating in the US is that how many days your employees were in the US. If we get a clue from trial balance or other documentations that they were sending employees to the US and there was an operation in the US, then you will be able to answer quickly less than 183 days, and we can file the tax return peacefully. But if you have not been tracking it, as Namir said, then it becomes a little bit of an exercise for you to figure out whether there was a PE or not. So yes, tracking it is the key. That is the fundamental thing that you need to be aware of before you do any planning or anything.
All right, let's talk about state taxes. So look, a Canadian company could conclude that they don't actually have a US permanent establishment. So we said that's going to protect them from US federal income taxes. And that they're only the misconception is that means that their only tax obligation then is going to be in Canada. But what's important to remember here is that many states take a position that they're actually not party to federal tax treaties, and that includes the US-Canada Treaty. So therefore, they're not going to actually be bound by this permanent establishment concept. And I'll tell you, one of the biggest exposure item I often see with M&A deals with cross-border entities, multinational entities, is a state tax exposure. And I say that because I think Canadian companies have gone pretty good in terms of making sure they're compliant from a US federal tax perspective. But often with state taxes, this is where a deal can fall through because they're not either managing it or they're not fully compliant. And this is important because, the construct of nexus is different than the concept of permanent establishment. So permanent establishment is a federal tax concept. Nexus is a state level concept. So this is around, does your business have substantial contact with the state for the state then to come back and impose income taxes or even sales taxes on you as an out-of-state taxpayer? And I want to mention that there are some US constitutional protections. So there's US constitutional and federal protections that are out there. And the two of them here that I mentioned are the Due Process Clause and the Commerce Clause. So what these essentially do is they give Congress the authority to regulate interstate commerce, interstate. And so what this really means is that it limits the ability of a state to impose an income tax on an out-of-state taxpayer without having congressional action. So what this really means is that if you're a state, if you're a state and you're wishing to impose income tax on an out-of-state taxpayer, you need to prove, okay, one, the taxpayer has substantial contacts with the state, but then you also need to prove for this Due Process and Commerce Clause that your state regulations, your state laws are not discriminating against interstate commerce. So you also need to prove that the tax is not being too burdensome for commerce between the states. Now, there's been quite the evolution, especially in the landscape of e-commerce and how how businesses are delivering products to clients. So this evolution that we're seeing in the tax landscape over the last, well, since the 90s really, in the last 30 years, started from this 92 Quill case. And this 92 Quill case basically said that you need to have a physical requirement before the state can start collecting sales tax. So essentially what this meant was the Quill case said that for you to say you have substantial nexus, or for the state to tell you you're going to owe taxes, it generally assumed you need to have physical presence. And when I think of physical presence, I think, either that means you have, employees on the ground or you're owning property. So prior to the Wayfair decision, and this happened in I think it was 2018, they came back and they interpreted the Quill decision and said, well, actually, physical presence is not required. So they overturned the Quill decision. And the reason for that is when you had this Quill decision where physical presence was required, well, if you were an in-state seller, so if you're a brick and mortar seller, you really couldn't compete with a remote seller, for example, somebody in Canada. So what the Wayfair decision did is it's a US Supreme Court decision that reversed Quill for sales and use taxes. And it said that, physical presence was not required for states to impose taxes, and it didn't violate the constitutional due process. It allowed for minimum contacts. So, and I want to give a little bit of background here on sales and use taxes, because, the US doesn't have a federal sales tax like Canada. So when you think about sales and use taxes, like it's actually quite burdensome, because we're talking about taxes at a state and local level, and this is over 13,000 jurisdictions. And more and more states are expanding their sales tax to also include services. So when you want to compare the sales and use tax, so sales tax, I think about this as a tax on a retail sale. And so this is based on the location of the customer that's receiving the product. A use tax applies on, for example, a good, although it could be services, that are purchased outside of the state and they're used or stored or consumed in the state. And then we have this Wayfair decision. So when the US Supreme Court overruled Quill, now you have several states are saying, well, you know what, we're going to have these sales tax thresholds. So it's similar to like the concept of economic nexus, where if a threshold is passed, well then, for example, if you have sales of more than $100,000, or if you have more than 200 transactions in the state, then you as a taxpayer, you as a business, will be required to register and collect sales taxes.
Okay. Well, how does that play into the merger and acquisitions, Namir? State tax, is that a key factor to consider?
Well, the thing to think about with sales and from an M&A perspective is U.S. sales tax are not incurred by the seller, right? But they have this obligation to collect and remit. So, if you think about this, if a Canadian company fails to charge state sales tax and is ultimately liable for the tax that it should have been collected, it may not actually be able to deduct those sales tax for Canadian income tax purposes. So, and the reason for that is the remittance by the seller is actually considered a voluntary tax, since the burden falls on the purchaser. So, and by the way, going back and trying to collect those sales tax from customers retroactively can be quite difficult. So there might be quite a big exposure there. And I think maybe the best way to think was I can give you an example. I have a Canadian client recently who got a notice from California. And what they said here is you have substantial sales in our state and you've exceeded this threshold and you'll be subject to California state income taxes. So they were required to file this California tax return. And one of the arguments we took back to them and said, well, the California Franchise Tax Board is subjecting them to California income tax because they violated federal law and said, they're prohibiting an out-of-state corporation from being taxed under, XYZ rules and circumstances. And California came back and said, well, sorry, those federal laws are meant to protect interstate commerce and not foreign commerce as a Canadian company. And of course, after that, the California came back and said, here's some interest and some penalties now on the taxes you owe. So the challenge we brought back to the California on that example was that the decision that the Canadian company was not engaged in interstate commerce is not correct because, yes, they're engaged in foreign commerce, but that actually was not true based on the facts that we had in that case. Interstate commerce, by the way, is not even defined in federal law. And so the argument was that you just can't look at where the company was located and say, okay, well, based on the fact that it's a Canadian business, you're not engaged in interstate commerce, you're engaged in foreign commerce. So we did bring back some evidence on that to support how the Canadian company was actually engaged in interstate commerce, looking at even having their California sales reps that were selling to customers in other states. They were even buying raw material from suppliers in other states. And essentially the argument we brought back to California was that they're actually discriminating between interstate and foreign commerce, which is actually unconstitutional under the US, constitutional commerce clause. Eventually California did withdraw their notice, but I think, probably because they didn't want to be challenging constitutional law, at least not over this case. But I think, again, it's, sorry, go ahead, Atif.
So just one question. So just because you don't have a permanent establishment in the US for US tax purposes, does not mean that you have escaped state tax. You could be paying state tax, but not filing the US tax returns. That's
absolutely right. And I think that's a misconception that happens pretty often, where a Canadian client or Canadian business sees that they don't have a U.S. permanent establishment. So they might be filing that U.S. federal return saying, hey, I'm treaty protected and I'm not paying U.S. federal taxes. But then the assumption is, well, then I'm not going to be filing anything in the States either because I have no permanent establishment. But again, that is really a federal tax concept, a federal income tax concept. And it's, you're entitled to that because of the U.S.-Canada treaty. But a lot of states are not signatories to the U.S.-Canada treaty or other treaties. Some of them actually go out of their way and add provisions to say that, we're not extending those benefits that the treaties provide. And the nexus threshold is, not only is it a different threshold, but it's actually a lower threshold than the federal permanent establishment construct. The one other thing I'll just add here real quick is just this concept of combined reporting. All I want to add here, just when I see I sense it to the time, is, there are some states that have mandatory combined reporting requirements. And what you need to know about that is that sometimes a state will ask you to provide the financials of other affiliated entities within a related group, within what we call a unitary group. And a lot of times Canadian businesses don't like that because they're saying, well, why does this Canadian entity that is not doing business in your state necessarily have to, include or report its financials to you? I don't want to open those books to you. And so you need to be cognizant of that, one. But I also think there's some interesting tax planning opportunities around combined reporting that could potentially manage or even lower your overall state tax exposure. You're up for a polling question now. So the question here is, if my Canadian business has no U.S. permanent establishment, then I have no state tax exposure. A, yes, the treaty always protects businesses from federal state tax exposure. B, if you have a U.S. permanent establishment, this will always trigger state tax exposure. And C, many states are not signatories to the treaty, and non-U.S. businesses can still have state filing or exposure. Or D, none of the above. Oh wow, 90%. That's a good score. That is correct. So the construct of permanent establishment is really at the federal level, and a lot of states do not extend those protections. Fantastic. All right. So the next slide here, I just want to talk about, because this really is our first webinar in the BizTax webinar series. We are going to dive into a lot of topics that we, briefly touched on today. So some of the webinars that are coming up is we want to talk about structuring your cross-border business. Another one is looking at U.S. federal and state tax incentives in terms of when you want to set up your U.S. business. What are some things to look for? The other one is cross-border employees, and this is what Atif and I were chatting about earlier in terms of looking at seconding your employees, moving your employees back and forth across the border, or even just having more business travel for your Canadian employees or hiring U.S. employees. The other one is around strategies to repatriate your U.S. business profits back to you as a Canadian shareholder or owner. And then the final kind of stage here in this webinar, I'm looking at the overall life cycle of a Canadian business with cross-border operations or investments. It's your final exit plan or sale of the business or acquisition. And if you have, by the way, any other topics in this area or any other suggestions, please do provide that. We'd be happy to bring it to the conversation.
All right, so we are at the end of our presentation. We will take some questions. Thanks for participating today. Do let us know through email feedback system, how do we improve, which topics you would like us to cover, and we will stay for questions now.
Thank you, Atif, Namir, for presenting in the first webinar of the BizTax series. So we have a lot of keen learners here and ask very good questions, but because of the time constraint, we will ask a couple of common questions. For any other questions we couldn't answer live, our report team will reach out to you after the webinar. So our first question is, can you have a US branch if you are a Canadian sole proprietor or only if you are a Canadian corporation?
You want me to go ahead and take that, Atif?
Sure.
Yeah, so the level of activity that you will have as a Canadian person, by the way, could be you as an individual or you as a Canadian business, as an entity. The rules are going to apply the same. So yes, you can have a US branch. if the activity that you're going to have in the US will exceed that threshold of having one, a US trader business, and two, if we're talking about a branch from a US Canada perspective. So that's the activities that exceed a permanent establishment. So if you do exceed those thresholds, then you will have a US branch as a Canadian sole proprietor. That's correct.
Right. And just to reiterate, you will have to keep the separate financial information for your US branch when filing for the US tax return.
Thank you. The second question is, does the CanCo have to recalculate the US division's profits and losses using Canadian income tax rules, because the US division is likely required to use US tax rules for US tax purposes?
A great question, actually. Do you want me to start, Atif, and then chime in?
Sure, I can jump in later. You can start, Namir.
Sure. I mean, I think the first thing to keep in mind here is that, the CRA and IRS just have different rules around how you go down from your financial income all the way to your taxable income. So the tax rules that would potentially apply for you to calculate your Canadian taxable income is not going to be the same provisions on the US side of things. So there are different rules to arrive at that US taxable income. And so you do want to, the first thing is you want to make sure you're tracking your US branch's income and expenses, and then you are going to apply different rules to arrive to that US taxable income. So there is definitely a separate, if you will, road to go from your financial income to your taxable income for CRA purposes versus for the IRS.
Right. So when you repatriate the money back, you can claim a foreign tax credit, as we had mentioned. However, we will talk, one of the topics that we mentioned for future is repatriation of profits. If instead of a division, there was a corporation there, and if that corporation is a controlled foreign affiliate, and that controlled foreign affiliate is earning passive income and is captured by FAPI rules, then you will need to use Canadian rules for that, for the calculation of that particular FAPI. And that's where it will become even, you are operating under the Canadian rules for passive income.
Thank you very much.
So I think we're probably close to the end of our time. I don't know if there's anything else. Well,
so yeah, so as Leigh said, that we will reach out to you individually for your other questions as well that we could not cover today.
Thank you so much for joining us today. I appreciate it.
Thank you, everyone.